Welcome to the Everyday Investor. I'm Sarah Larbi. I am your host for today, and we've got an exciting show coming up with a great guest who is a great friend of mine as well and has also retired from the 9-to-5. But if you guys are at home and going to work week in and week out and thinking, is there a better option out there? There is. You can start looking outside the box, so you don't have to be working for 40 hours a week for 40 years only to retire on 40% of your income. Stay tuned and don't go anywhere. We'll be right back. Coming up, we're going to be speaking to Sarah Eder on scaling your portfolio, retiring from the 9-to-5 using the joint venture strategy.
So that way I was able to scale up really fast because I don't have to save my own down payment money. I don't need to qualify for mortgages. All I need to do is find the deals, be the expert, manage the buildings after we do it, do all the renovating and the refinancing piece, basically all the hard sweat equity piece. And then after that, we get to just keep scaling up with the same or different partners.
The mortgage world has changed. Has your advice? Are you looking for a modern approach to your mortgage planning process? Advice tailored to your unique, ever-changing circumstances? Whether you're upsizing, downsizing, purchasing, or refinancing, the Kyle Ford Mortgage team works with individuals and companies to custom tailor the right mortgage product for you. Working with a wide selection of lenders, we're here to serve our clients and help them achieve their real estate and retirement goals. Contact the Kyle Ford Mortgage team today, Canada's mortgage choice.
Welcome back. Before we get into our show, we are going to be hearing from Omar Khan, who is a stock expert for the Stock Minute.
Thanks, Sarah. Omar Khan, guys, here with the weekly market update. Markets are doing pretty good. They've had a good run so far this year. S&P 500, the NASDAQ, the TSX. However, September is statistically the worst month of the year for the stock market, and we're seeing that come to fruition. Now, we're heading into the last week of September, and that's kind of like the worst of the worst period of the entire year, statistically. Let's see how things play out, but I would expect a bit of a market pullback. And the first half of October is pretty good. Second half can be a bit wonky. And then we get onto something called the Santa Claus rally, where the markets generally tend to do well towards the end of the year. But all this, of course, will be dependent upon corporate earnings. Ultimately, that is what drives stock prices. How much money did my company make? Now, the good thing is corporate earnings are doing well. Now, the concern right now is these things called rising yields. The bond market's a little heated. Yields are going a little higher, so it's inflation concerns there. Let's see what happens. But corporate earnings are great, and hopefully we have a good second half of the year. Back to you, Sarah.
Thank you, Omar. So I'm really excited today for the show. We've got a great friend of mine, Sarah Eder, who's been able to scale her portfolio without using any of her own money and using the joint venture strategy. And as investors, we always want to ask ourselves different questions, right? About an investment and if it's worth doing. So what's the ROI? What's the return on investment? When do I see it? What is the minimum amount required? And what are the risks? So welcome to the show.
Yeah, thanks so much for having me. It's exciting to be here.
Good. So you've really built a large portfolio in a matter of how many years?
3.5.
3.5. And do you mind if I ask how many units or how many doors you have today?
I have about 225 doors, but I know it more by buildings. We have about 57 buildings right now.
That's incredible. Yeah. And I think I've known you for a while as you were starting your journey. So for somebody that was starting out, what are some of the things that you were able to do starting out with no money, no financing? Maybe share a little bit of your story with us.
Sure, absolutely. So when I first got started, like you said, I really had nothing. I had just retired from my professional athletic career and I wasn't sure where I wanted to go. So when I fell into real estate investing, I knew I was going to have to get creative because there was no way I was going to get mortgage financing or have the down payment money. So I started to get really proficient on social media. So I really educated myself, took the time to really dive deep into the markets, gaining all those skills. And then I just started sharing my journey on social media, telling people what I was doing, the types of buildings I was looking at, and through there was able to get some of my first investment partners.
That's amazing. So for those at home saying, what is a JV? What is a joint venture? Do you mind explaining a little bit about how that works?
Absolutely. So for those of you kind of interested in getting into some of this stuff, joint venture partnerships are basically where somebody else goes on title, They put down the down payment and basically hold the financing. So that way I was able to scale up really fast because I don't have to save my own down payment money. I don't need to qualify for mortgages. All I need to do is find the deals, be the expert, manage the buildings after we do it. Do all the renovating and the refinancing piece, basically all the hard sweat equity piece. And then after that, we get to just keep scaling up with the same or different partners.
All right, so just to take a step back, essentially you are the active partner, bringing in the expertise, bringing in the deal, bringing in the management piece, and they are the passive partner in this case, right? I mean, there's definitely different ways that you can slice and dice the joint venture agreements, but you're bringing in these passive partners that are putting the money down for the down payment, for the renovations, closing costs, all that good stuff, and then they're also holding the financing. And do you mind sharing, like roughly, how do you guys split that, right? Because there's now two different parties in the mix.
Yeah, and it can get really dicey. So that's why it's really good to talk about it, talk to your lawyer, get advice from accountants when you're doing this, because there's so many different ways to break up a joint venture partnership. We do it a really classic way, just 50-50. We like to keep it really clean. So it's basically 50% of all the cash flow and 50% of any of the equity proceeds after we sell the property. So that means the investors always get their initial down payment back, all the capital they put in for renovations and closing costs, and then anything above that, we split 50-50.
That's really interesting. So what's a timeline, for example, like if you have somebody that's interested in working with you or one of your joint venture partners, are they looking at 5 years? Is it 3 years? Are you able to share some insight on that?
Absolutely. So typically our standard time is 5 years. We find that because we do a lot of the BRRRR strategy, which I'm sure we'll talk about a little bit later, we do refinancing. So that means we ship a lot of the equity out of the properties right after we renovate. So there's not a lot of piece of the pie to go in after we've done that refinance. So we find it takes at least another 3 to 5 years before we can sell and therefore get a little bit of profit back for both partners.
Yeah, that's interesting. So what are some of the potential downsides of going this route, right? Rather than just acquiring your own properties in your own name with your own money. I mean, it sounds like there's lots of upside in the sense that you can scale quickly. But there are definitely pros and cons to every single strategy. What are some of the cons to joint ventures?
Absolutely. There's always cons to every type of real estate investing. And with any type of partnership like this, there's always downsides. Obviously, I'm splitting 50% of the profits. If I were able to do and scale this by myself, I wouldn't have to give up the profits. Of course, there's also other personalities in the mix, right? So that means that I have to worry about other people's expectations, other people's, emotions and things as we're doing deals together. So there's a lot of maintenance, a lot of relationship and hand-holding that I have to do throughout the process. And, again, managing those expectations. Everyone answers to me, my contractors, property managers. When things go wrong with the building, I answer to everyone. So I'm, there for the good times, the bad times, it all really falls on me. So it can be a lot of pressure and a lot of stress. It's also the type of investing that I had to phase into a full-time career doing it because, it really is a full-time job to be able to manage a property for someone else. When they give you money, I am now obligated to return their capital and get the best returns possible. So that means I really have to commit to the process, and it can be pretty time-consuming.
Yeah, absolutely. I mean, especially if you're hands-on with the management piece, I guess that would be my next question is, what do you do from a management standpoint with 200 plus doors?
Yeah, so just recently we actually outsourced a lot of our company. It's really important that people understand that, a portfolio isn't just collecting properties, you're building a business. And so this past year we spent a lot of time outsourcing and delegating, which I think is the most efficient way to scale a big portfolio. So we outsource property management, we outsource accounting and bookkeeping, and we even started to outsource some of our general contracting for construction. So that way I'm able to just look at everything from a very high level, make all the big day-to-day decisions, but I have people on the ground, doing the execution on the day-to-day.
That sounds awesome. It sounds like, all of a sudden you've got a ton of doors, but for those at home just starting out and they want to, put themselves in your shoes, get their first, their second JV deal, essentially, where somebody else is bringing in the money and the financing, like what are some tips that you could offer them?
Yeah, so the first couple are always the hardest. And I always tell that to people, until you've built up a reputation online and you've really built up street cred, so to speak, it can be really, really tough to, tell people, yes, give me, $200,000-$300,000 when you don't really have a track record. So my best advice is to become the partner that you would want to see. So if, you think if you had $200,000 and you wanted to give that to someone, what would you be looking for in that individual? Well, you'd expect them to be market experts. You'd want them to have a good team to kind of surround them and support them. You'd want to see that they have systems in place when things go wrong. So I always say, take the time to not just raise the capital, but build yourself up as the best investor you can be. Get to know your markets, get to know the types of properties, build up that power team around you. And so that way there's a little more trust there, especially if you don't have a huge track record.
Yeah, absolutely. I mean, team is important. It's how we've all become so successful with our real estate and got to where we are today. Because without a team, if it was just us, we'd be probably working 100+ hours a week and not as efficiently. That's for sure. Yeah. So obviously, building the team is important. Anything else that they should focus on? Just even in terms of, like, for example, if there is a deal, like, should they find the deal first, or should they find the person first? Like, what comes is like the chicken or the egg, right?
It is such a chicken and egg question, and I get that a lot because it is tough. There's a delicate balance. Like, do we find the funds first, and then what if we can't find a deal, and then what if we have too many deals and not enough investors? So in this day and age, I think that honestly finding the deal first is really positive. Back when there was like a buyer's market, it was a little different. We could, it was tougher to raise capital, whereas nowadays there's such low inventory and everyone's looking for properties. If you can become that person that finds really good opportunities and really good deals, there's money out there waiting for you. Just make sure you understand what goes into the deal part with your JV partners. Make sure you have those joint venture contracts, that you understand all the legalities, because you don't want to just get stuck with a property and then not understand the steps kind of following that.
Yeah, absolutely. So you're saying property first, but maybe cultivating a little bit on the side through social media and different measures.
Exactly.
So you've got somebody to go to and say, hey, are you interested in this opportunity? But you don't necessarily pick your joint ventures first and then you go for the property. You just kind of maybe have a pool of opportunity of people that might be interested, and then you present them with the deal. How do you ensure that you don't get stuck with it?
And that's a really tricky component to doing joint ventures, is sometimes, and I've been in the situation myself where I find an amazing opportunity, I kind of pull the trigger because I'm so confident, and then now I'm stuck with a firm deal and no money partners in sight. So it's super important that you pick the right deals that have multiple exit strategies. And even though I didn't have money to start, I did have access to private lenders. So if I needed to emergency close the building, flip it, put it back on the market, sell it, I've done all of those things and everything in between when I've been saddled with properties like that. But if it's a good enough deal, you should have enough exit plans if that JV doesn't come through. And as an aside to that, always make sure that you're signing documents with the JVs. You might not get like the joint venture agreement right away, but you can sign letters of intent. You can sign contracts with them to make sure that, they're not kind of stringing you along and pulling out at the last second. You want to make sure that you're kind of covering your tracks that way too.
And it sounds to me that goes back to the team, right? So having a good lawyer, having a good mortgage broker that might have access to private money in case you need to close with private money rather than a joint venture. And so all of those people would be in place to just help facilitate that whole process, so that your contracts are actually written by a lawyer and your letter of intent is actually, done correctly and all that good stuff.
That's right.
Yeah. Awesome. So, obviously 3.5 years is quick. And not everybody is going to be able to go as quickly. But you obviously have some students and you have some students that you coach through. Are you able to share a little bit of maybe their struggles that they've had and some of the, like accomplishments from those struggles?
Yeah, absolutely. I would say that probably some of the biggest struggles they have is getting the confidence to do a JV. When we broke it down, in this talk, it seems pretty straightforward, right? Well, just go find a property, just go post on social media and get a partner. But so many people are terrified of the potential. They're scared to actually pull the trigger. So I think what I try to help people do the most is just overcome that, feel confident that this is possible. Just because you don't have money doesn't mean you're not worthy to own real estate properties, and that you can be still providing something of value to the table. It doesn't have to be financial. It's just getting into that mindset that you're valued and that, you're worth it.
Absolutely. Mindset is huge. I mean, they say that, real estate success is 95% mindset and 5% everything else. And so if you think you can or you think you can't, you're right.
You're right. Exactly.
Absolutely. Don't go anywhere. We'll be right back.
At Theta Training, our goal is to help you achieve financial freedom by teaching you the foundations of trading stock options. Join our growing community. Learn through our live-streamed weekend course, or develop your skills at your own pace online. Understand how the stock market works and how you can use the options market to earn additional income. Achieve financial freedom and live life on your terms. Let us help you build your empire.
Welcome back. I'm Sarah Larbi, real estate investor and now co-host with Toor on the show. And I'm excited to bring you numbers very, very shortly. But before we do that, and before we dig deep into a real deal that Sarah Eder has done, let's bring in Kyle Ford for the Mortgage Minute, because none of this is going to happen if you don't have a good team in place like we talked. So Kyle, take it away.
Today, I want to talk about refinancing before the end of term. When it comes to refinancing before the end of term, you're likely going to be facing a penalty. If it's a variable rate mortgage, it will more than likely be a three-month interest penalty. If it's a fixed rate mortgage, it will likely be an IRD, interest rate differential. These are the penalties that can be $10, $20, $30 plus $1,000. I see many Canadians, when it comes to these penalties, hear the number and stop. I don't want to pay a $20,000 penalty. I will not break my mortgage. Let's take it a step farther. Let's run the numbers and compare those rates, the new rates versus the current rate. And even after paying a penalty, I'm finding more and more Canadians finding it much more worthwhile to pay the penalty and get into a better term product. If you have any questions, don't hesitate to reach out to myself and the Kyle Ford Mortgage team.
Thanks, Kyle. That was very informative. So, Sarah, I really want to take a deal and just really dig deep into all of the financials because, as real estate investors, of course, it's mindset, like we were mentioning, but numbers are going to be key, and buying the right ones, doing the right renos, all that good stuff is important. So, what is the deal that you want to talk about today?
So I just recently completed a BRRRR project, so a buy, renovate, rent, and refinance project in Brantford, Ontario. It was a vacant duplex that we put a lot of construction into, and then we just recently refinanced so we can hold it now for about 5 years.
All right, so you're joint venturing essentially with a BRRRR project, and you're holding that for 5 years. What was the purchase price of this duplex in Brantford?
$325,000.
All right, and just for time purposes, when was it that you actually purchased that?
We purchased that October of 2020.
Okay, so not that long ago. Yeah. 325 duplex in Brantford. Are you able to share a little bit of maybe the area? Is it an A area, an area that is in transition, or what does that look like?
Yeah, so I would call it kind of like a B neighborhood, definitely up and coming, more towards like the central core of Brantford. And this was actually an abandoned vacant building. Anyone that knows Brantford, that's pretty cheap for a duplex, but it was completely abandoned for about 7 years before we got it.
Okay. So abandoned in Ontario, sometimes in a sense, it's good that you can set your rents and you can do your renovations essentially with the way that the RTA works. And so you found this building, you got it under contract, and how did you source your JV from there?
So I basically brought this to one of my longtime joint venture partners. Knowing the condition it was in, there was holes in the ceiling, tons of water damage, all of the electrical, plumbing, all the utilities have been stripped out of the building over the years. So I knew it had to be a JV with a good appetite for risk and a good budget for renovations. I really try to assign my deals based on the risk tolerance of my joint venture partners. So I have an email list of people that I've kind of vetted over the years. And so I got all the financials put together, sent it out to my newsletter list, specifically kind of targeting the ones I knew were sort of more risk tolerant, and actually got a JV pretty quickly on this one. So
okay, so now is it 5 people that were interested, or was it one person and then you kind of just worked with them, or how does that work? Because you send the deal over, and you probably have a list of more than just a couple people. So how did that work out?
So typically at any given time, I have anywhere from like 5 to 20 investors, depending on how good the numbers looked. On this particular one, I actually had 2 or 3 serious JVs, just because it was almost a $200,000 renovation. Abandoned building, it was really hard to see what it was going to look like at the end, so it scared off a lot of people. But in general, it's kind of like first come, first serve. I have to get a mortgage pre-approval from you. You have to sign a letter of intent. If you don't sign those, no deal. First come, if you bring everything to me.
All right, awesome. So they came to the table. You're like, okay, this is one of the few that I've selected that could work well with this project. So what did they bring to the table at that point in time? And I'm guessing that regular financing was probably, depending on that house, if everything was stripped out, you're probably not going to the bank for financing. So maybe just walk us through that.
Sure. Yeah, and that's a great point, because this wasn't a deal where we could just go to a CIBC or an RBC and get a conventional mortgage and refi it. We had to go private for this one. So basically, my joint venture partner, he went on title. So he held the mortgage, put the down payment, closing costs, as well as contributed to the renovation fund. So basically any hard capital that needed to go into the deal, he provided. So we reached out actually to Kyle Ford, and he actually provided the mortgage on this one. And he helped us source out private funds. And so I think we got a 75% loan to value mortgage, plus actually some construction funds under the private loan.
Okay, so they're coming down with the down payments, the 25%, obviously, the reno closing costs. What is that in total?
I believe the total cost of all the cash in was $275,000. That was also including the renovations.
Okay, so renovations, closing costs, down payment, all that good stuff. And then what did you do with it afterwards? So you essentially started renovating it. Can you walk us through maybe some of the renos that you did?
Yeah, absolutely. So this was a really fun project because I got to gut it from top to bottom. I had a really substantial renovation budget. We spent about $175,000 on construction. So we got to add in an HVAC system. It didn't originally have one because it's a century home. We got to put in AC. We got to put in really nice high-end finishes because it was kind of like a heritage looking house, 10-foot ceilings. So we put in pot lights, modern finishes, vinyl flooring, stainless steel appliances, granite countertops. Really did a spectacular renovation on it. It ended up becoming a 3-bed, 2-bath upstairs and a 2-bed, 1-bath on the main level.
That sounds awesome. And it's also one of the things we got to be a little bit careful because there is, renovating for the area and then there's over renovating. And sometimes when you're a brand new investor, you don't know how much, is over renovating and how much is under renovating. So it's important to have that fine line of what exactly needs to be done in order to get the best value. Because ultimately what we want is the ARV, which is after repair value, which is the refi. So just to summarize though, so they paid $80,000 for the down payment. Closing costs $19,700.
Yes.
Your renovations were $175,000, and then renovations complete. What do you do next?
So we got it tenanted. It was actually really easy. To your point, I was almost afraid that we were almost over renovating for this particular neighborhood in downtown Brantford. But we thought, it's a big, beautiful house. We're going to kind of take the chance and try to get really good quality tenants. We succeeded. We got phenomenal tenants at above market level rents. So once we got the tenants in place, got everybody moved in, we then got our occupancy permit and then basically took it back to the credit union where we were going to get the mortgage and refinanced.
Okay, so the refinance is usually my favorite part of it where you get a big check. So what did the refinance come out to be?
$715,000.
So you bought it for $325,000, you put in, the reno cost, down payment, closing, and $715,000 in Brantford, downtown, B-ish area with awesome tenants. That's awesome. Congrats.
Thank you. We did great. Yeah.
And so with that, you still have the tenants that are paying rents. Are you able to share what the rents are and then the cash flow?
Yeah, so each tenant is paying approximately $1,800 plus hydro. So overall, it doesn't cash flow tremendously because obviously we leveraged the mortgage quite high to pull all of our capital, but that was the goal with this property is we just didn't want to leave any cash in the deal. So we're cash flowing net, and that includes a CapEx, so repairs and maintenance, as well as a property management fee, and we're still netting $5,600 a year.
Okay, with none of your own money left in the
None
deal.
of the money left in.
That's awesome. And then, so let's just say, we've got, just to figure out what our ROI is, or return on investment,
Yes.
you also want to look at natural appreciation. So what do you take for that? Just estimating if you've got somebody and you're holding the property for 5 years with them, what are you looking at for appreciation per year?
We do very conservatively. Obviously, we know in Ontario things have gone a little crazy. It could be 15, 20, whatever it is. We do kind of like the CMHC standard, which is 5% a year. So usually there's much more by the time we're done with it, but this way we kind of play it safe.
Okay, so you've got your 5% natural appreciation, then you've got your mortgage pay down. What do you have for your mortgage pay down there?
I think 11,800.
Okay, awesome. So you've got your mortgage pay down, you've got the appreciation, you've got your cash flow, and essentially your ROI becomes infinity because you've taken everything that you put in back out.
That's right.
Yeah, that's cool. That's very cool. So, but to be realistic, that's not always going to happen that way.
That's right. Yeah. Particularly with burrs of this size, there's always issues. And we were very lucky because we did run into issues. We ended up having to put in a new water main from the city because it had broken over time. All those little things that come up with large renovation projects. But we were very lucky that the market had drastically increased throughout COVID. So we were able to really absorb that lift. But there's times when you can't absorb that lift and that comes kind of straight out of your bottom line. On average, we're leaving about $30,000 to $50,000 in our deals after refinance, which is still very good. But these ones are kind of the gems of the portfolio.
Yeah, absolutely. So then walk us through what happens to the joint venture. When do they get their money? Like how that all works out, and then just in terms of like moving forward from a split standpoint, what that looks like.
Absolutely. So again, the JVs that we do are all 50-50. We like to keep it very clean, very simple. So the way it works is 50% of that net cash flow will get paid to my joint venture partner, and 50% of that $5,600 will come to my company. We usually do payouts like either end of year or quarterly, and that's kind of like the reoccurring payment. Now, the investor gets paid immediately after refinance. So the way we do it is, because that was all their funds. It was their reno funds, their down payment funds, and their cash essentially. So I don't take any of the refinance proceeds. That goes back to the investor. Once they are paid back and made whole 100%, everything above that is considered profit. So if we made a profit from this refi, I would have taken 50%. In this case, I think we literally just broke even, so I didn't take any fee for that. And then moving forward, all that mortgage pay down and natural appreciation becomes the profit. So when we sell, for this property, I think it's going to be about 5 years, we will list it, and then basically we take the legal fees, the realtor selling costs, and then any net leftover from there, we split 50-50.
Amazing. And how many of these are you doing, whether it's an annual basis or a monthly basis? I mean, not necessarily the ones where you're pulling out everything, but just deals in general. Like you probably have an average at this point of how many deals you're offering on, how many deals you're actually closing on.
Absolutely.
What's that like?
So we are closing on about 25 to 30 deals a year now. Sometimes it fluctuates. We have sometimes right now we have 12 construction projects on the go. Sometimes we only have a handful, but on average, we're putting in offers on almost 5 to 10 properties a week. So it just goes to show you, it's really a numbers game. You have to put in a lot of offers to get these types of deals.
Absolutely. And it sounds, like it's all good and it's great, but there are going to be some risks, right? Like you could over renovate, your after repair value may not be where you want it to be. You might leave more money than you want in the deal. So there are going to be some risks. So definitely what would you say to people at home that are looking to do something like this?
I would say the best thing I can say is check your numbers. Yes, things can go wrong with the construction. Yes, things can physically go wrong, but it's all in the buy. And I'm sure people have said that 100 times, the money is in the buy. Just analyze, triple check, get other people to look at your numbers, your broker, your friends, make sure with 100% certainty that you have built in buffers, that you're not over exaggerating, your ARV because you want the numbers to work. Do not fudge the numbers, be critical, build in buffers, and then that way, no matter what goes wrong, at least you can absorb them and still make the deal a success.
Yeah, absolutely. Great tips. What's next for you?
I am now moving into the commercial space, which is really exciting. So we've had a huge run of success with the residential side, but it's a lot of transactions to do on a monthly basis. So we're now moving into apartment buildings so we can kind of leverage my team's time a bit better.
That's amazing. And if somebody wanted to reach out, where can they go?
You can visit my website, so www.saraheder.com.
Amazing. Thank you so much for being on the show. Thank you to the audience for tuning in. I hope that you enjoyed today's show. And don't forget, tune in again next week, same time. And we would not have a show if it wasn't for you guys. Thank you so much.